Good morning, everyone. Well, the dollar's lower against almost all currencies Friday morning in Europe, including most of the emerging market currencies that we track. Among the G10, the only currency to decline against the dollar was the Swedish krona, which was still lower after yesterday's surprising jump in unemployment. The dollar was hit by a combination of weaker than expected retail sales for January and higher than expected initial jobless claims. So the recent string of worse than expected indicators from the U.S. is calling into question the recovery scenario there. The implied interest rate on Fed funds futures, which had gained 6 basis points after Fed Chair Yellen's recent testimony, slipped 3 basis points yesterday as doubts about the economy crept in. 10-year bond yields also slipped 3 basis points and are now back below levels prevailing before Yellen talked. This is quite notable, as she was expected to be considerably more dovish than she actually was, and the market was at that time, before she talked, discounting a change in tone at the Fed. So with a loss of higher interest rates, a loss of support from higher interest rates, it's only natural for the dollar to weaken. Against that background, the recovery in emerging market currencies was notable. Out of the 15 that we track, only the Russian ruble and Hungarian forint were lower compared with Thursday's opening levels. Now, one might think that a slowdown in the world's largest economy wouldn't be good for these countries' trade, and hence wouldn't be good for their currencies either. That makes yesterday's gains all the more notable. It may be, or it looks like confidence is coming back into the emerging markets, and the risk of contagion in the asset class is diminishing. Now, today is GDP day in Europe. We have the preliminary GDP for the fourth quarter from France, Germany, Italy, and the Eurozone as a whole. French GDP rose at a stronger than expected 0.3% quarter on quarter. It was expected to be up only 0.2%, which in any case was a turnaround from minus 0.1% in the third quarter. Germany's growth also exceeded expectations at 0.4% quarter on quarter. It was expected to be up only 0.3%. Italy's GDP is expected to rise 0.1%, and the GDP for the Eurozone as a whole is expected to have accelerated to 0.2% quarter on quarter from 0.1%. But of course, that could exceed expectations given the better than expected result in Germany and France. On the other hand, U.S. industrial production for January is estimated to have slowed to only 0.2% month on month from 0.3% in December, and the preliminary University of Michigan Consumer Sentiment Index for February is forecast to decline a bit from January. So we've got a positive growth surprise from the Eurozone, confirming that the recovery continued at the end of last year, and we've got more disappointing U.S. indicators. That could encourage the Euro-dollar bulls to overcome the 137.35 resistance area. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.